Welcome to Upside, where we dig into the real stories that live behind the headlines affecting European venture. Today, it's Mads, Lomax, and myself, and today we're talking about AI and cyber, what's happening there. There's lots to discuss about the government, funding, spending reviews, investing in AI, energy again, but there are some big plans afoot. We've got Sizewell C, we've got small nuclear reactors, Tesla's Robotaxi, oh my goodness, Tesla's finally launching their autonomous driving. 996, founder work ethic, a really tricky topic to discuss, but we're going to dig into that. Some AI up to the right growth. We're looking at Cursor, OpenAI's hit 10 billion, and some private markets versus public markets. Now, it doesn't feel like a day goes by without there being a new cyber attack in the news. M&S last month here in the UK, personal data of millions of customers compromised in a Dragon Force, aka scattered spider breach. United Natural Foods in the USA saw an 8% share price drop when their supply chain was recently disrupted by a cyber attack. UNFI, just for context, UNFI serves 30,000 stores across the US, and AT&T saw 86 million affected users by an alleged Russian cyber attack. What does this mean for business? What does this mean for us as startup investors? What does this mean for founders? How is this all going to piece together? Lomax, can you give us some background and your take?
So, yeah, I think it's well documented, and you give good examples of where cyber is having real world impacts, and the numbers just keep going up and to the right. So 43%.
It feels like there's more, right? It feels like we're seeing a lot more.
Yeah, both anecdotally, and that's also borne out in the data, right? So 43% of UK businesses suffered cybercrime in the past year. So nearly half of all businesses. And then the global average attacks per organization climbed 47%, now at 2,000 attacks per week in Q1 2025. So I think there's no doubt that this is going in one direction. Why is this happening? I think a lot of the sort of AI-enabled tools, AI makes it easier to launch such attacks and more efficient.
Mads, what else is going on? Where are the opportunities? How should we think about this?
I think are kind of two vectors that I think are relevant. One is this is opening a new vector of attack to a degree we haven't been used to in the past. It used to be sovereign states fighting sovereign states, and because these attacks are now taking the proportion they have, it's almost like either non-state actors or state-sponsored actors in rogue regimes are attacking the fabric and the integrity of our societies in ways that were unheard of in the past. Something that in the past you would have associated with a pandemic or a war. And it's sort of happening, I wouldn't say under the radar because it is headline news, but to some extent we're making it sound like it's something that's happening a little bit out there in cyberspace, but it's having very real impact on the day-to-day economy.
It feels like it kind of, they appear in the news cycle, but we kind of dismiss it. It's like it's almost such a constant drumbeat that you don't really pay much attention to these cyber attacks, I think.
I think it raises new questions for what constitutes warfare in the 21st century and how we should respond. So that's one thing. Another thing is that United Natural Foods shares fell sharply last week before the attack happened. So you have, I think, some very sophisticated, nefarious actors that not only know how to attack, companies and get a ransom out of them, but also know how to leverage the financial system, for example, by shorting shares to get a double benefit. So this is not, I don't know, some, unwashed teenager sitting at home in a kitchen playing around. This is sophisticated stuff. And it sort of begs the question, how should we respond? And, obviously we have kind of sophisticated cyber defenses, but the question is whether they are enough.
Well, and the other kind of follow-on question I had for you is, are we going to see less kinetics? Are we going to see less trad warfare? Because obviously we're all, looking at defense spend, buying subs and boosting troop numbers. Is this the real new front?
Sadly, I think it's going to be a combination. If only we could replace kinetic warfare with cyber, we could say, okay, well, the shelves might be empty for a day or two, but nobody's going to starve to death. But I think you'll see a combination, and we won't be able to take our eyes off one just to concentrate on the other. We have a new front, effectively. We got to man it permanently.
Well, I think we've perhaps had this front for a while. The front on both the business industrial side, and then there's in warfare. And if we move to more autonomous systems within warfare, so drones, automated vehicles, etc., then clearly this becomes a major issue. But then also on the, company industrial level, the stakes are even higher now. I mean, reflecting on the Spanish, Portuguese, Iberian electricity blackout, which we're not saying was a cyber attack. In fact, it wasn't. But easily, if you are able using cybercrime to take out these systems, you paralyze economies.
Russia bombs food distribution depot, leaves 30,000 stores empty.
Yeah.
Now compare that to the reaction you get from this. Okay, so people are saying there are no human casualties. Fine, but if that was a power outage that led to hospitals stopping to function, you might not get off as lightly.
I think that's one of the, if you think about like old economy businesses, which are a big time affected, M&S and food supply chain companies. I think that's one of the problems with cyber, because it's a very abstract concept. So actually at the board level, to think about these threats historically has been quite hard, and therefore, to kind of put the systems in place. I think now you see more and more of these real world consequences of it. I think that will make people wake up and smell the coffees and put infrastructure in place to try to defend these. But this is all, unfortunately, cyber's one of the ones where the nefarious actors always seem to be one step ahead of
It is
the
cat and mouse,
defenders.
isn't it? It is. And also, there are so many different flavors. There's ransomware attacks, where it's just a purely financial gain. There's Mads's point of there's, state actors not only making money, but also, really messing with their enemies. There's all kinds of reasons for it.
I think there's a third zone. So the actors here likely originate from either North Korea or Russia. And you're not going to tell me for 5 minutes that the local authorities couldn't find them if they tried. Right? And so that's what I mean. It's almost like we have opened a new front, which is it's more than a cold front because it has real world implications.
Guys, also, cybersecurity as an investment category within venture has been a pretty sizable category over the last 15 years. I mean, what was the biggest exit in Q1? 33 billion. Whiz, no. This is not some new thing. It will become, the market size will grow, and it will continue to be a place where if you're a founder, there are massive opportunities, and if you're an early stage investor, there are huge opportunities.
So I think that the new thing is it's reaching a scale where it's no longer just a business concern. I think this is a national security concern.
Well, let's talk about government spending, because governments are spending more on tech and AI. There's been the spending review. There's been lots of announcements from government on investment in infrastructure and AI. Just for some context, UK private investments into AI were 20 times lower than the US. And Jensen Huang gave Starmer a bit of a dressing down at the lack of investment in AI infrastructure if we really want to see the UK as a leading powerhouse. However, we are seeing more local investment, plus there's new programs to encourage foreign direct investment into the UK. And like I said, it's not all winning. So the economy shrank, inflation hasn't been tamed, and we're seeing more job losses. So lots of announcements, Lomax, lots of good, not so good. Give us some background and your take on what's happening here.
So this week we had Rachel Reeves on Wednesday announce her spending review. So just to remember, every year she does a budget, which sets the annual spending and tax take. This is the spending review, which actually is much more important. This focus on a 3 to 4 year lens, set spending parameters for that. So this is actually a much more important fiscal event than a budget, which is very interesting. And I would say backdrop, as you alluded to, Dan, was not so good. UK economy contracted 0.3% in April, and 109,000 jobs were lost, which is the biggest monthly job loss since COVID. 250,000 jobs have now been lost since the last budget. And the 109,000 jobs happened in May, which is the month after the April national insurance social security payments were increased, something we've discussed on this pod before. So the backdrop was not great for Rachel Reeves, let's put it that way. However, the optimist in me says there's some really good things in this spending review. The big winners actually were tech, science, and the NHS. Maybe let's park the NHS for the moment and look at what's been unlocked on the infrastructure and technology side. So big picture, 140 or 120 billion of spending in kind of critical infrastructure over the next 3 years, including 43 billion into science and innovation and technology. This is a big win. The AI opportunities plan, which has been outlined before, has now been fully funded at 2 billion. So I think that's very, very interesting. good that she's allocated the resources to that, including, I would say, learning lessons. About a third of that 2 billion AI investment is a 750 million supercomputer in Edinburgh. This actually was cancelled back in August last year by Rachel Reeves. And this was seen as an example of where they're not investing in the right areas.
So that's back on the table.
It's back on the table. It's actually sort of the 750 million is included in this 2 billion of spending on AI. So it's a big component of that. And I sort of dug into this a little bit. And I think that's interesting because if you look at, so Matt Clifford, formerly of Entrepreneur First, works, now as chairman of ARIA, and he laid out or led this AI plan that the government has, and a core pillar of that is increasing by 20 times the compute infrastructure that we have in this country. And actually, this supercomputer is a large component of that. So it sits firmly within that policy, and I think it's great to see. I think it's 50 times more powerful than the current largest sort of research-focused supercomputer that we have in the UK at the moment, called Archer 2. Clearly, at the macro level, the government is going to need to borrow a lot of money to fund this. In fact, all of this investment is not coming through tax increases, she says, at the moment.
Well, she hasn't said no, has she?
Well, she hasn't said no, but she's deferred it. But it basically means another 140 billion of debt chucked onto the national debt, which at the last check, I think was 90%. The GDP to debt ratio was 96%. So this will push it into the 100% plus category. So, and when you look at the growth numbers, we just talked about where the economy is heading, that will obviously, low growth means lower tax take, which means lower ability to service your debt. There's a risk of a kind of death spiral that you could get into, but let's perhaps
somebody's got to be brave, right? Because this is going to go beyond potentially Labour's tenure. Somebody's got to be brave because there's a massive period of inertia, isn't there, between investment and return?
Yeah. And I think I'm just pick out a quote from Rachel Reeves, which is, I have made my choices. In place of chaos, I choose stability. In place of decline, I choose investments. In place of pensions, division and defeatism, I choose national renewal.
We will fight them on the beaches.
Okay, yes. But I think in a way, this is her being brave and pinning her colours to the mast. And it's a much better direction to take things. We were sitting here in the last 6 months crying for investment, which we did not see in the autumn budget last year. And now we're seeing investment, and we're seeing it in the right area. And this thing does take time to filter through. But I think it's, there is a sort of backdrop to this, which is that aging, which a lot of Western economies have, which is the aging population that we have. And I think the FT have worked out that by 2029, 49% of government spending will be on health and social care. This, in my view, is a major crisis. We're moving to a major proportion of our national budget being focused on these areas, which is not innovation, R&D, growth, etc.
Well, this is the point, isn't it? Because this is somewhere where startups are also and investors are scared to play, right?
They are. And actually, interestingly, on the health side, there's been 10 billion allocated across these 3 years to digitalize the NHS. I mean, whatever the hell that actually means, but still there's an acknowledgement of marrying these two problems is like invest in technology to actually solve one of the big secular problems that we have. On that, I'll shut up, but I'm broadly as optimistic as I can be, despite the very negative backdrop that we have, and also the relatively poor start that we had in terms of investing in the areas that we care about.
I like that she's being brave. Mads, what would you add?
No, I think you're spot on. I think the 2 billion for the UK AI action plan is good. I think, money to invest in making our healthcare system more efficient is good. What I'm missing there is the bravery to say, okay, so here are where the efficiencies are going to be, because what you're saying is essentially right. The budget is not sustainable. The money we are spending on things like healthcare just keep growing and growing and growing with worse outcomes. And in fact, we are delivering less today in the NHS with more money than we did in 2019. It just can't be true. And so I would have liked to see some of the bravery actually be saying, okay, here's a 5-year plan. We're going to give you some money to invest, but we expect efficiency on the other end. And we expect that 5 years from now, with all that new technology, you'll be able to deliver more with less, not less with more, to free up resources for all the other things that need resources that are underinvested. Taking a step back from healthcare for a minute and just coming back to AI. So I think What Jensen Huang said was wonderful. He sort of said, this is a Goldilocks moment for the UK. You have perfect talent, you have investment, you have government support. You just need the infrastructure to execute, and then you have the government coming up with £2 billion, and that's wonderful. NVIDIA also had the announcement around the UK AI lab, which sounds very cool. At the same time, NVIDIA has also announced that they're going to put $500 million into creating an industrial AI cloud, kind of an AI factory in Germany. So there's a little bit of a contrast here, which is that it seems that we're getting some nice words in the UK and this sort of slightly ephemeral AI research center, but Germany's getting real money to build an AI factory, which of course is what we need. And if you compare the announcement here around the 2 billion with what we've seen, Project Stargate in the US, Project Stargate in the UAE, where it's an order or 2 orders of magnitude more money going into building compute and compute capacity, it seems that we still have some ways to go. And so I hope we can move from sort of the slightly old-fashioned, we'll make our 5 or 10-year plans, we'll allocate some money, we'll hope good things happen, to much more proactive. Let's go and find the deals. Let's find the movers and the shakers, like an NVIDIA, like other partners we can find globally, to attract capital and do deals now, to bring in the investment we need to really get things moving. Because otherwise, Dan, as you're saying, if we're taking our sweet time on this, Reeves and everybody else will run out of time before the parliament is over. And once again, we won't have really moved the needle. And that's a little bit my concern, is the speed we're moving now, that it may be too little, too late.
Well, I mean, at least they're making moves. I hope it's not PR. I hope there's it feels like there's real forward motion. And I also hope, because we focus on it, we're not, happy ears listening for the things that we want to hear. But it does feel like there's many more positive investment announcements from government and then leading into the private sectors. And one of those is in energy. Now, obviously, we talk about this a lot. We need energy. We need it to be cheap. And that's not just for AI, but AI is certainly going to be a massive driver of this requirement. Nuclear is back on the table. We're seeing Sizewell C, a £14 billion pledge to kick off Sizewell C in the UK, although that is a 10-year off plan, assuming all things go well. Rolls-Royce has won the UK government backing to build the country's first small modular nuclear reactor. And in the States, just flicking over to see what Meta's doing in Mexico, they're now looking at geothermal as an energy source and then piping that back into the States. So energy's massively on the table for all of us. There are obviously opportunities for startups, investors, activity in general. Lomax, what should we focus on and where?
So I think setting the backdrop here, which we have discussed before, but I think it's worth just rehearsing this. So the UK and our peers in Europe have the highest cost of industrial energy in the world. Like, it's staggering. Like, I think the cost of industrial energy per our latest report is 6 times that of the US. So this is very, very shocking. We also have problems around sovereignty on your energy supply. If a lot of your electricity is being generated by gas-fired power stations, then the gas is generally something that you're importing. And we've seen that from places like Russia, that when you have these global macro shocks, that the gas prices go up, and you're very, very dependent on that. So you have a sovereignty issue, you have a price issue, and then there's also the cleanliness issue. Funnily enough, nuclear, and I'd love to get your take on this, from my understanding, nuclear solves 2 of those issues, not 3. Okay, so nuclear gives you long-term baseload as opposed to intermittent, which we have with solar and wind. So long-term baseload, a plant will last for 40, 60 years, and like clean power, consistent power, and also gives you sovereignty over your power, gives you control over it, right? Because, by definition, it's on your shores and you don't have to rely on imports for it. However, I was shocked by this, having spent a bit more time on this. The cost of nuclear energy is the most expensive energy out there.
Is it? I didn't know that.
Yes. So it doesn't solve, and the reason why this is relevant in the context of technology, obviously, is, we need energy for data centers, and if AI needs electricity, is hungry for it, could potentially be up to 30-40% of electricity use in Western economies over the next 5-6 years. So it's a huge problem. So if you want to use more AI to drive more efficiency within your economy, if the cost of that is prohibitive, that is clearly going to be a massive rate limiter on that. So
I thought the small modular reactors, and there's a lot of new tech going now into France. Remember that UK startup that moved to France to build these small reactors? I can't remember the name of it.
Nucleo.
Yeah. I thought they were quite low cost.
What the cost, but I don't know what the cost per megawatt hours. But also these SMRs, the small modular reactors, are very small, so they're not really needle moving, But the cost, there's this concept of the LCOE, right? The levelized cost of electricity, which basically takes the different, because you have a nuclear plant, once you've got it up and running, will last for 60 years. So you have the upfront cost, like Hinkley Point C in Somerset is potentially going to cost 35 billion. So you have a huge upfront cost, and then you of course amortize that over the time of the life of the plant. But the cost of the electricity coming out of that is roughly going to be £150 per megawatt hour versus £50 per megawatt hour for solar and wind. So actually, these big nuclear plants solve your energy sovereignty and future planning, etc., but they do not solve the cost of electricity. And so that is just something to bear in mind. I think it's great we're investing in it for reasons I've just said, but let's just not lose perspective and sight of that. SMRs, I think, these small modular reactors, will probably yield or offer a lower price per megawatt hour. I'd love to know what that actually is, but I do think we should just bear that in mind.
Okay, Mads, what else do you want to add to this?
Yeah, so many things to unpack here. Where to start? Look, we've had decades of chronic underinvestment in our energy infrastructure. And we then wake up suddenly and say, gosh, there's a gap. We need to invest. And we choose an absolutely gargantuan project that, right, the biggest project one can imagine, not having done this for decades. And lo and behold, it ends up costing twice as much as comparable designs in France, 4 times as much as nuclear designs in Korea that are well functioning today. And so it begs the question, could this have been done a lot cheaper? And instead of sort of a 30-year stop-start cycle, we've been building smaller plants along the way. But positive probably could. Second point is that a lot of times energy is priced not on the average cost, but on the marginal cost. And it turns out that when you have unsteady energy supply and you rely a lot on renewables, and renewables are wonderful, you have to fire things up and down all the time. And that can be really expensive if you have to go back to, for example, gas plants and fire gas plants up all the time to deliver marginal capacity. So I think there's just a lot that can be done to make the energy strategy and policy more coherent and less stop-start. And it's a little symptomatic.
Can I just ask a question just to clarify that? So, because I think this marginal cost is something that's underappreciated. That basically means, as far as I understand it, is that if you're drawing electricity from a number of different sources, so wind, solar, nuclear, coal-fired, gas-fired, when they set the price for it, in the whatever periods they set the price, like hourly, 24 hourly, they actually choose the highest. They choose the highest cost of all of those modalities, right? And that then sets the price, as far as I understand it, which means you're actually selling nuclear or you're selling wind by reference to the gas-fired price, which is obviously very dependent on the gas prices, which have gone up a lot.
That's exactly right. So yes, we need more stability. And I don't think we can choose just one of these energy sources. I think nuclear is wonderful as a baseload. It's a lot less polluting than coal. We just can't build one plant every 30 years and expect economics of scale. So I think what we need to do now is to say, okay, we've gone all in on this. Let's double down on it. Let's, instead of thinking about one mega project, can we then fold this into another 2, 3, 4, 5 projects to get more capacity, to scale this up? If there are any new inventions here, can we bring them to the wider world? Can we make more of it than just a one-off that ends up being a really, really expensive science project?
But it's financial, isn't it? I mean, it's money, isn't it? If they've committed to this, is there enough free float to then go and commit to other projects?
Yeah, well, Rachel Reeves, fiscal rules, its investment is not counted. She's looking at the net debt.
The SMRs can cost, I think, roughly 2 billion per project, rather than 35. These potential blank checks that you have with these big nuclear facilities. So I think they've only approved, I think, one in this spending review. You would have thought that they could approve a series more and roll them out much more quickly and in a much more adaptable but versatile manner. I mean, it will require lots of forward thinking and and flexibility on planning, et cetera, but you could have thought that that's a sort of lower piece of hanging fruit. And we can talk about the moonshot nuclear fusion type things, but I mean, that could be 2040, 2045.
Always
I mean,
20 years off, baby.
it's like quantum is 10 and like nuclear fusion is 20. It feels like, but good to see. I'm sure you read that Proxima Fusion, a nuclear fusion company in Germany, raised a big $130 million series, 130 euros Series A this week,
Nice.
which is a big announcement, which is great to see.
We've had some incredible advances in fusion over the past year alone. We've had 22 minutes of sustained plasma energy generation out of the Tokamak West in France earlier this year. There's just so much happening. And yes, 20 years, but if it's 20 years to, sustainable, limitless energy, I mean, it's not so far away, is it?
It'll probably take 20 years to complete HPC. Size or C, sorry.
I wonder what the levelized cost of electricity is actually for nuclear fusion, the LCOE, 150 for nuclear and then, 50 for solar and wind. I mean, clearly there's a lot of analysis that needs to go into that and assumptions based on the cost of actually building a plant, et cetera, but it'll be interesting to see that.
I think we're all fairly bullish insofar as we think that energy will be solved within our life cycle. I think that's where we will kind of sit. But let's move on to Elon's Tesla's Robotaxi self-driving is here. Apparently, Mads, what's happening?
Well, Tesla was meant to launch Robotaxi services in Austin yesterday on the 12th of June. And initially, we're just kind of planning on rolling out 10 to 20 Model Ys. They've been seen driving around Austin driverless, but the start of the Robotaxi service itself has now been delayed to the 22nd. Now, on one hand, of course, this is revolutionary. Tesla has got the world's largest fleet of, potentially self-driving, capable cars. Massive data advantage, scoping up data from cameras everywhere. So this could become a big thing. And there's the context around the cost. So Waymo, which in many ways have been ahead, it costs $180,000 to build one of their cars due to the high cost of the LiDARs and the sensors they use, whereas the Tesla car is only $40,000. So much cheaper. But the reality at the same time is that Waymo has been ahead. They're doing more than 250,000 paid trips per week already. And so Tesla is desperate to catch up, and they're hoping to launch ASAP. Is it sort of a standard Elon Musk playbook here? You can compare to what Waymo did. They had 6 months with safety drivers and 6 months without them before they launched. Whereas Tesla is looking for just a few weeks.
Elon needs some good news, right? He needs some good PR.
Does need some good news. But listen, when you take a step back from all the personal and emotional excitement and everything else, this is a big deal, right? Tesla Robotaxi is a car that can drive itself around a city, costing less than $40,000. It can revolutionize how the world works. And so I think it is worth paying attention to.
Coming
to Europe, Lomax, what's happening? How will this affect us over here?
I totally agree. I think this is a massive deal. And I think that probably very on brand for Elon, the whole Tesla rollout will have a little bit of move fast and break things, and the PR will be a bit messier than Waymo. But, as Mad says, the Tesla cars, because they're just using cameras as opposed to the more expensive LiDAR, which the Waymo cars use, are about a quarter of the cost. And Elon actually thinks, I think at the beginning, they'll price around similar to Waymo, so around $1 a mile. There'll be a booking fee of $5, $6, I think. Elon predicts that you can potentially get the cost down to 20, 30 cents a mile, which is just insane. Imagine getting... So I think this is a huge deal. And imagine what that can unlock in terms of people's commutes, like new jobs they could potentially take, like how this can affect people at the individual level. I think it's fascinating. And so
But I do wonder one thing. I wonder how many in the fleet, or how many private owners in the fleet, will let their car be used potentially in such a way. That's the thing. I get the self-driving taxi piece, fine. But I always wonder how the network is going to work.
I think it's B2B. I think you have fleet owners, people do it as a business rather than individuals, just like renting out their cars.
So you don't think it'll be like a car share service?
Maybe, but I think that will just slow things down. I mean, it's interesting, but I think the main thing will be people rolling out commercial fleets of these things. Europe, you asked about Europe. I think this is interesting. We've just had some more news with this with Wave in the UK, which has now inked its second partnership. So as a reminder, Wave doesn't actually roll out its own cars. It's a pure software company. They've now, having signed a deal with Nissan, which we talked about 6 weeks ago, have now inked a deal with Uber, and whereby Wave's embodied AI will launch with Uber in spring 2026, which is a year earlier than planned. Shock horror. Interestingly, I don't think any of us are big Brexiteers here, but this automated driving has been an area where there is a bit of a Brexit dividend, because the UK is now moving a lot faster than the EU in the context of AVs, right? So this trial between Wave and Uber will be level 4, like the highest level of autonomy and automated driving. So that will be on the streets of the UK next year. The EU is stuck on level 2 or 3, is weighed down by the lowest common denominator country, which I think, according to Elon Musk, is the Netherlands at the moment, which for some reason is slowing things down. So, the context here is that China and the US are way ahead in the rollout of automated vehicles. UK and EU need to catch up. The UK actually seems to be doing something about it. The EU is stuck in, without wishing to, excuse the pun, in first gear.
God, well, you are a dad, so dad jokes are allowed. It's fine. It's fine. Mads, any more to close off on Tesla and self-driving and taxis and fleets?
No, I think you're right. I think Wave is Europe's hope on the automotive front, and I hope they can pull it off. And if it's a Brexit dividend that ends up creating the bedrock for the software company that becomes the autonomous DNA for kind of for saving Europe's automotive industry and making sure we can compete, then that would be a funny twist of fate.
Or we leave that to BYD and just convert all our plants to building subs and tanks and missiles. Maybe that's where we'll end up.
This is another thing that creates risk, talking about cyber risk. If the whole of your mobility infrastructure in a city is relying on AVs, like that's another that creates a whole new category of risk, right?
Yeah, because if you get somebody hacking into the Tesla network and just flicking your car off mid-journey or however disruption they're going to do. But anyway, we're going to see, I guess we'll see more as we're more interconnected. Yeah.
But you're touching on something that's super central there. And there was the whole discussion around whether the Americans could switch off our F-35s, right? I mean, think about this. I mean, one thing is a cyber attack, but if Europe becomes populated only by automotives built in China, what does that do to our security posture?
Yeah. Oh, blimey. Well, I want to talk about another cheery topic. So it's come around again, this whole how hard should founders work, this whole 996 narrative. So I kind of don't want to talk about it because it's, founder salaries, founder work ethics, how hard should founder works. There is obviously a very strong venture theme here where it's a lot of VCs that have been talking about this, and it's been picked up and it's kind of hit the airwaves again. Lomax, where would you start, if anywhere, if you're up for it?
There's been a lot of polemic and a lot of strongly worded and minded pieces put out in the last week off the back of this LinkedIn post that Harry Stebbings made about founders need to work seven days a week. I just have a kind of relatively simplistic view of this, which is it's specific to each founder. They do what they need to do. We live in a bubble, which is the venture-backed founders. There's tons of entrepreneurs who don't take venture and build fascinating, wonderful businesses that don't take venture money and don't need to get to hundreds of millions of revenue. That's never the plan from the outset. But if you are in this small world of trying to grow big companies, I'm afraid there is no real substitute for intense hard work and focus. And, you look at this slightly artificial concept of trying to force this growth onto a small organization and take it from, say, 0 to 300, 400, 500 million or a billion of revenue within 7 to 8 years. There is no substitute for elbow grease, I'm afraid. And we look at companies like Revolut. They're not created in the European context without an insane amount of hard work. So I think it's up to them. I'm not telling anyone what to do. I just know.
Yeah, but this is the difficulty, isn't it? Because we're sat on this side of the desk as VCs. How very dare we? But I think there is a reality to this, right?
How very dare we? We're just like, guys, you don't have to take our money. You can do what you want. If you want to take venture capital is an expensive piece of capital. If you want to take it, it has its demands. And guys, we know that. Also, we in order to attract money into venture capital, you need to show a risk adjusted or like a return that is competitive with other asset classes. So for that to happen, you need these given the high failure rate, which is not going to change anytime soon, you need these big outcomes. And those big outcomes, I'm afraid, they're not going to come with 9 to 5 work. I really don't think they will. I also think there's like, so anyway, I think it's up to the founders. I think this stuff does require an insane amount of work, and there's often no substitute for that. I would wanted just to maybe touch on a quote from Paul Graham, which I find very interesting because I think it depends on the age and experience of the founder. And I think I don't know, before handing over to Mads on this is what Paul Graham wrote. So use the advantages of youth when you have time, and the advantages of age once you have those. The advantages of youth are energy, time, optimism, and freedom. The advantages of age are knowledge, efficiency, money, and power. With effort, you can acquire some of the latter when young and keep some of the former when old. But horses for courses, everyone is on their own journey. I do think, though, if you want to build a company of 50 billion in market cap, you got to work frigging hard, and much harder than me and most people out there. You need to work in the top 0.1% of people on this planet.
Yeah, it's dedication, right? Mads, do you want to wade in?
Yeah, I mean, so how I've seen the discussion being painted is people are saying, look, the reason Europe is sometimes seen as behind is because there's a lot less capital. Just give us more money. That'll help us hire more people. We can build bigger teams instead of working like maniacs. And the only reason why Europe is not producing more great outcomes, because there are some, right? There are companies that are amazing. The only reason there aren't more is just because there's a capital gap. I think the really inconvenient truth here is there can be a bit of truth on both sides. So yes, we need more capital, but Lomax, as you say, there is also a widespread misunderstanding of what it takes to win in a globally competitive marketplace. I think Revolut proves the point. People are talking about a toxic work culture, but it turns out that this is actually one of the very few companies that have been able to compete. And what Nick has created there is a company that is absolutely peerless globally, or at least one of the very, very few that are right at the top in their category. So that is what it takes if we want to compete at that level. If you want to be on the top of the Olympic podium, you have to have an Olympic level commitment to winning. There is no other way. And it is whatever it takes. And yes, part of that is bloody hard work. And so that's just the way it is. You can't holiday your way to trillion-dollar companies. If we want to compete with China and the US, if we want Europe to remain a kind of a rich and an affluent region with great companies that are competing globally, we got to work hard.
I always fear having this conversation. As VCs, I always fear having this conversation. However, I think those founders that truly understand venture capital, speed of sale, speed of scale, global stuff, I think they get it. I think they want it. I don't think this is news to them to be obsessed with their thing they're building on the problem they're solving 24/7. I just don't. I don't think that's. I don't think for those is a challenge.
You know those founders, and you see them, and you work with them, and you know how passionate they are, and that's why you can believe, and we can believe that they have a shot. It's no guarantee. Even with money and hard work, you might still not win, but it's an entry ticket that gives you a shot at that dream of building a globally competitive business that can be number one in its space, category leader. And for many people, that won't mean anything, and for some, it is the only thing that matters. And I think if that's what you have, if you want to have that Olympic level, a victory, and you really want to be number one, you know what it takes.
Interesting quote from one of the partners, A16Z, in the context of AnySphere, the company behind Cursor, who last week said, I read in an article in The Information, I haven't seen people working this hard since the first internet boom. So read into that what you like. And this is actually where that Harry Stebbings LinkedIn post came from, because I listened to the show where he was chatting about it. Was they were basically saying, if you go to San Francisco at the moment, one of the Americans on the pod was explaining that it's on fire at the moment with people just working the whole time. Now, again, some of that I'm sure is inefficient, et cetera, but the people, we know what San Francisco and Silicon Valley has produced in the last 15 years. We know what it's producing at the moment. We can see, OpenAI at 10 billion ARR, right? So to do those kind of extraordinary things requires a Herculean effort. And Dan, importantly, you shouldn't worry about this, man. It's not for everyone. So it doesn't matter. Tons of entrepreneurs on LinkedIn who for whom this is irrelevant, and they should ignore it. They shouldn't comment on it. They should just get back to doing what they're doing. So
I know.
I think it's.
I'm with you. I'm with you. I think what the challenge that I have is that I don't believe that many founders truly understand the expectations around venture capital. And I think that many founders look at it as a natural evolution from bootstrapping to angeling, and then I'm just going to go and raise venture. It feels like a linear path.
There's no divine right to venture capital, quite frankly. And also, you're right. It's actually, this is not some just like source of funding to help grow your company, like in a sort of linear fashion. It's actually a very weird instrument that is demanding that you grow in like something that actually is incredibly artificial when you think about it in a company, in a company journey. So yeah, I think there is a bit of a kind of understanding mismatch, maybe. I mean, one thing that is a bit tedious is people being extremely prescriptive, but that's just, that I think a lot of that's just clickbait. There's some people who are just like trying to cut through the noise.
It's an emotional hook, isn't it? Whenever I talk about, and I don't mind having really difficult conversations, whenever I talk about founder salaries or venture capital or venture growth or what, the expectations on founders who actually take VC money, it's an emotional hook, and some of the tech press is very good at playing that emotion. But we were talking about Cursor and AnySphere, and obviously, as you mentioned, OpenAI have surpassed 10 billion ARR this week. So there's a lot of AI companies doing crazy up to the right stuff. Looks incredible. Can it be sustained? Where are the lines and boxes? What's coming to Europe? How is this transferring over the pond? Mads, do you want to start with this one?
Yeah, sure. I mean, some people have said, oh gosh, look at those ARR multiples. Aren't they outlandish? But I think that's not the real story here. The real story here is that companies are doubling revenue every 2 months, which is it's unprecedented in business history. And, you gave the example of Cursor or AnySphere, which is the company behind, right, at 500 million of ARR. I mean, it's just nuts that you can double every 8 weeks. We've not had quite as many of those mega amazing stories in Europe. We do have Lovable from Sweden, and they've just hit 61 million of ARR in June. And I think that's fantastic, right? Because they're up from 17 million in just 3 months. So it's kind of a 3.5x growth. And they've had this path they've gone on and shown that, we can build incredible companies here. Now, Lovable is still only a sort of a tenth the size of Cursor, but they are definitely doing something right. Some people have asked, why aren't we seeing more European AI companies share their numbers the way we see from the US? And of course, it's just because they're just not growing as fast, except outliers like Lovable. And that does, I think, in many ways point to the thing we talked about above. If we want to be number one globally, we've got to work at least as hard. We also need the capital, but we need to work hard. There's just no other way if you want to win.
Lomax, is it all good revenue?
I think we don't know because we just get the high level numbers. So I think we're still learning about the P&L profile of these companies, what the gross margin looks like. This is not necessarily the traditional gross margin that you would see in a pure cloud SaaS company, for example. So I think people are still learning about that. I think OpenAI have actually put out a gross margin number that I think is much healthier than we were expecting, which I think they put out recently was roughly 45.
I thought they were losing still.
No, 45% was the gross margin that was quoted. Okay. No, it'll be a net loss surely at the EBITDA level, but at the gross margin level, I think 48% gross margin is the last I've come across. So I think, actually these kind of more vibe codey type companies like Cursor actually, and I think Windsurf, they are negative at the gross margin level, which obviously is potentially very concerning because, actually, how the hell do these companies actually become profitable and make money? Now, clearly, I think the cost will go down for them over time as the technology gets more proliferated and commoditized. So that probably is heading in the right direction. Cursor has been valued at 10 billion now. So clearly investors see something heading in the right direction there. We have questions over what's the churn look like. I mean, I'm not churning from ChatGPT anytime, OpenAI's products anytime soon, but what does the switch off rate look like, the churn look like? I think TBC, still very early. Because don't forget that at some point, someone is going to have to run a discounted cash flow model on these companies. So at some point, people are going to have to look at the cash flow generation or cash flow generation potential. I mean, that's ultimately how you value companies. So I think, we can't just forget about that. We need to be building to something, to some level of profitability. The only thing that's interesting is the developers who are using, for example, Cursor, are they, or the users of Cursor, are they, going to switch when something, better comes along? And I don't think it necessarily needs to be 10x better or 10x cheaper. And actually, the Christoph Jans, the founder of Point Nine, I read an interesting article that he put out basically saying, these developers are much more flighty. They're not like lawyers or consultants or kind of people who are slower to switch once they've actually made the purchasing decision.
That's exactly right.
Will competition as it rises start to eat the lunch of these companies? So I think all of that is TBC. At the moment, the ARR numbers are really heading in a great direction. And, I don't think there's anything to be worried about. I'm sure they're doing what every company does, which is they're cherry picking what they absolutely need on the ARR side. But I mean, most investors will be able to DD their way through that. So interesting times, still a lot to learn though. Don't forget, for all these big numbers and all the excitement, we're still learning. We're still building the train as we, roll down the tracks.
And a lot of this stuff is still very much at the foundational level, at the core level of AI. And there's still so much to do as these Cursor-esque and other application layer organizations
and
roll
no doubt,
into
by the way,
business.
no doubt we'll see casualties. We'll be sitting here in 2 years' time and a few of these companies would have gone up in smoke. But that's literally how venture capital works.
Yep. Bring it on.
It's
let's talk more about private markets. Let's talk about more about VC. We have some fairly historic news where VC and private markets have always been high performers, but no more, according to the latest data. In the US, for the first time in 25 years, private markets have fared worse than publics across all metrics. So what's the real story here? How is this going to affect us? What's happening in venture and startup land, if anything? Mads, what's your take?
Well, you're absolutely right. In the headline, it looks like, why would anybody in their right mind bother with private markets? You can go to the public markets, you can buy a tracker, it's completely liquid, you can sell it day to day if you want, and you've had better returns. So it does sort of, at a surface level, look like we're all going to work with X on our faces. Why are we wasting our time with all this hot stuff when we could just sit at the Bloomberg terminal? Of course, the story behind that is that it's mainly Magnificent Seven, right? They've driven 61% of the S&P 500 returns. It's been a very concentrated tech dominance. First, it was just because, mobile and cloud was amazing, and then AI came along, and that's amazing. And so the kind of these 7 companies have really won there. And at the same time, on the Ps, especially on the kind of private capital, the buyout firms have been struggling, because they're needing targets, right? They've done a lot of the low-hanging fruits in terms of, buying and shaping up and shipping off. And so it's been hard for them to, first of all, go into a higher interest rate environment, meaning that deals have to be kind of leveraged buyout companies. A firm will put some capital in, but a lot of it is leveraged. So you'll borrow a lot of money to fund the acquisition, and then you'll try to turn that company, make it more profitable before you sell it. Interest rates have been going up. That's not helping. That means the valuations go down. It means it's more costly to finance the debt. So you've had the kind of all the headwinds from that. And then you've also had an eroding stock of companies to buy, because many of the low-hanging fruits have been done. And on the venture side, you've had the post-ZERP bubble, you had the ZERP bubble in 2020, 21, 22. You've had that overhang. And that's just really depressed returns. So you have a sort of a confluence of two things happening at the same time. I think under the covers, the best managers still outperform. The easy money era is over, but we fully expect that venture will start to shine again, especially with the AI boom. And I think there is a real opportunity in private market valuations, because the publics have become expensive in many ways when you look at these tech companies. So yes, the startups may look expensive also, but you look at some of these growth rates that we're seeing. The growth rates are unprecedented. The TAM is unprecedented. And I think the best GPs will not only survive, but they'll thrive. But the mediocre ones will face extinction. So there's going to be a shakeout here, no doubt.
Shaky. But also, can't ignore the fact that where we are in this innovation bucket. This is where all the magic happens. This is what's going to create the next wave of IPOs and magic Mag 7 companies that are going to then hold up public markets in another 20 years. Lomax, what would you add?
Absolutely. Absolutely. I think what's new here, for the first time, the incumbents didn't just take it lying down, right? I mean, Google, NVIDIA is not a young company, right? All these incumbents were ready, and they've been readier than ever before. And so this is part of why I think so much of the initial value has accrued there. But I agree with you. Next wave, you're going to see startups eat into that lunch.
Yeah, you have to be in it to win it, right? If you got to meet luck halfway. So, Lomax, what would you add?
I think Mads has summarized it incredibly well, but I would just make the point that I think this is pretty seismic in terms of the news, right? I just think, across this is a report by State Street tracking, on the private side, private equity, private debt, and VC, and just taking, last year those assets as a cohort were up 7% versus the S&P 500 at 25%. So the difference is staggering. And then this report tracks performance over a 1 year, 3 year, 5 year, and 10 year horizon. And this is the first time, as you said, that on all of those measures, publics are outperforming privates. And as Mads said, publics are liquid. You can sell them whenever you want. Private, you could be locked up for 10 years. It's like you need to add, not only does the private equity needs to have a illiquidity, effectively discount applied to it. So I think it shows that we in the private markets have a lot of work to do. All of the reasons I think Mads has covered very, very well. Private equity had very low interest rates. They bought and sold and squeezed the life out of the low hanging fruit companies, and a lot of the value creation has taken place in AI within the public markets this time. But this will change, no doubt. Look at what's going on in space. Huge amount of value being accrued in the private markets only. In AI, also, a lot of these companies are still private. In the intersection of technology and biology, these kind of next generation technologies, I mean, nuclear fusion we talked about, that's all obviously private markets. Quantum, there are listed players, but that's largely private markets. So I think that will drive the next wave, and so it'll be interesting to see how these reports look going forwards. But I think it's a bit of a wake-up call for our industry and for us. When we're pitching our own funds to investors, they're like, well, hang on a second, why am I going to commit to a 10-year lockup when I can go and buy QQQ? Well, we talked about this before. QQQ is the Nasdaq tracker or Nasdaq Composite or an S&P 500. So we need to earn our fees and earn our illiquidity premium, I guess, as it were.
Well, watch how it all shakes out. I think the let's talk about some of those deals. So there's a bunch of deals of the week. Mads, what's on your list?
I'll just pick one here, and we'll start with Multiverse, which is a Spanish startup that has just raised 189 million euros. And why have they done that? Well, let's go back to Lomax's point from before. Some of these AI companies are running with negative gross margins because the stuff they buy, the tokens they buy from the big cloud providers, are really expensive. Multiverse, what they specialize in is algorithms that can compress large language models by up to 95%, making them smaller while still maintaining their accuracy. It sounds like magic, and it may just be. They're working with a bunch of customers, and it's actually interesting to see Europe is taking sort of a bit of an efficiency play here to Silicon Valley's bigger is better. Could this be sort of Europe's DeepSeek answer? Who knows? That might be too early to say. I think it's exciting validation for European deep tech in the AI space, and it shows that while we may not be leading, there's certainly some very, very exciting tech here that's marching forward.
What that will mean for compute. I wonder if there will be those efficiency gains like DeepSeek punched everyone in the face a year or so ago. And Lomax, what's on your list?
I just checked my CRM. I did pass on that company. So
no, passed on Elvis. Shit.
Yeah. But at least I saw it because this company came out of San Sebastian in Spain. So it's like, well, part of my job is seeing companies as an investor. So at least I saw it. Did you guys see it?
No. I met the founder. I met the founder in Barcelona. It was too late for us.
So at least I saw it. And there's a question of, as a VC, you often ask, did I see the deal? And did I see it at the right stage? Because anyone could see it at Series B or whatever. Actually, I did see it at the right stage. For various reasons, didn't invest because I think one of the questions. Clearly, I was impressed by them looking at my notes, but one of the questions you always ask in Europe, particularly for these kind of deep tech companies, is are these people are going to be able to raise the kind of money they need? And that's a major constraint that we have in Europe for at that time, pre-commercial deep tech companies. However, great that they've done it. So good for them. And I feel fine. It's part of my job. I should be, I should be missing out on some of these opportunities because I just need one or two, right?
At least you saw it.
IonQ, a big listed US quantum company, has acquired a Oxford-based quantum company for just over $1 billion. So largely stock, but it's liquid stock. It's IonQ stock, a little bit of cash. Bought Oxford Ionics. So Oxford Ionics is a spin out from the University of Oxford working on trapped ion architecture, quantum computing, which is also the architecture that IonQ, which itself is a spin out from Duke University. Interesting. I mean, I think it's a big exit in European terms, north of $1 billion. Like, congrats to the investors. I think the last round they raised was a large seed or small Series A. So I'm sure the markup is very, very good for those who invested. But there's grounds for optimism and pessimism here. There's like, oh, great, this is a good exit. And don't forget, we used to talk about the 300, the 400, the 500 mil exits. Remember when DeepMind exited, everyone was like, woohoo, this is amazing. This is 2x that. So at least the expectations have shifted. But still, at the same time, it's disappointing that actually we have a company that is probably selling too early in its journey. I mean, look at IonQ, which is a similar age to Oxford Ionics, this company. And IonQ is now valued, I think, with a market cap of roughly $10 billion in the US. So an exit north of $1 billion, we should all be happy about that. But at the same time, there's always leaving that feeling of, well, what could it have been?
Super. Oh, no, it's exciting stuff. It's exciting. There's money changing hands in the UK. I'm gonna stick with that. But before we go, I just want to send condolences to anyone affected by the Air India crash. It's hideous seeing things like that. There's a lot of hideousness going on in the news cycle. A big, especial condolences to anybody affected. Gentlemen, a pleasure and a gift. I will catch up with you fine people next week.